Okay, folks, welcome back. This is the first of our daily uploads. We're going to be doing the review mentorship level on the YouTube channel, examples I gave for the Optimal Trade Entry Pattern Recognition series. All right, so this is the May 14th, or example number 6 in the series of 20. So we'll be doing example 6, 7, and 8 in this video. The midweek lesson and the weekend lesson will be teaching specifics about daily bias. So that, again, that's keeping with the theme of this week. So I'm going to try to drive hard a lot of discussions about the daily bias. Okay, but the examples here, I'm just going to add the lipstick from the things that would be gleaned from the mentorship core content and week commentaries and charter membership. All right, so let's take a look at the crude oil market. And this is the June contract. And we'll add the annotations here. All right, so right here, this is the 13th of May, right there, 13th of May 2020. And at that moment, forget all this exists, okay? We have a consolidation here, which we'll see clearer when we drop down to a 4-hour chart. But for now, just know that we are in consolidation here. We drop down, reverse, low risk buy. So right away, you already know what I'm talking about. Market maker buy model. And when we drop down a lower time frame, you'll see all of the side of the buy model here. Everything will match up over here. But before we get to that, I want you to take a look at this candle here on the 13th of May. Now right away, we have this large gap that's going to be a draw on liquidity. Then we have the old high here, and the likelihood that the market will want to reach above this original consolidation at the very minimum. And then obviously you've known that we've talked about the crude oil market even going up into the gap, and it has done since at that time of the recording is when I did it on YouTube. So anyway, this candle here, it looks like a little plus symbol, okay? That is compression. Now compression is when the market is creating a very, very small trading range and it's about to release and go one-sided with energy. A lot of magnitude and directional bias will be more pronounced on one direction over another. Okay, so whenever you have a directional bias, like we're indicating here, and as I indicated in the example, and since then has gone up even more, reaching for our objectives here, the compression in price is like a spring being wound up tighter and tighter and tighter, compressed, and then let go of. And when it takes off, it will run really quickly to an objective. Now, by itself, if you look at a candlestick like this one here, it's usually promoted by Steve Nielsen and the folks that really make a science out of looking at individual candles, like it's some kind of a foretelling of what the market's going to do. That is randomness. This thing I'm talking about here is not randomness. It's based on a theory that I've adopted from Larry Williams, where he talks about small ranges bring big ranges, then small ranges, and then big ranges, small ranges, big ranges, small ranges, big ranges. So you compare what the market has done in the last few days. And one of the things I like a lot about the Street Smart book from Linda Raschke and Larry Connors, they talked a lot about what Toby Grable did in his book. Talked about a lot of the day trading ideas that lend well with narrow ranges, like in the smallest day or daily range in the last 5 days. You can actually use parameters a little bit longer than 5 days, like the last 20 trading days, the smallest trading range in the last 20 days, the last 10 days, the last 5 days. Okay, and I like looking at that. And whenever you see a range compress to its smallest degree in a defined range, and I rewind the video and you'll hear me actually give you those specifics that I look for, it gives you a lot of anticipatory evidence. Okay, in other words, we are anticipating a big move, an extrapolated move, one direction over the other. Now, by itself, the candlestick doesn't give you that direction. It just means that it's likely to create an expansion move. because after compression, imagine that spring in your hand, a metal spring, and it's wound up really, really tight or squeezed together. And then if you let go real quick, what happens? It springs to life and jumps out of your hands. Now, you don't know directional wise where that spring is going to go, but the other things that lend well for directional bias, we can see the market maker buy model here, the consolidation. We drop down, smart money reversal, low risk buy here. And then looking at all of this in here on a lower time frame, we'll drop down to an 8-hour and a 4-hour chart. And you'll see how all of these points here match up that leads to the complete efficiency of the sell side of the curve and in the buy side of the curve, leading to a run above the original consolidation. Okay, the contract for June expired on this day here, so we don't really have any data for this one, but you can look at the symbol for crude oil July delivery month would be CLN as in Nancy 2020, and you'll see that it actually has gone up even more. But nonetheless, this is a indication that we're going to see a big move. Now, directionally, we can see that we're part of the buy side of the curve on the buy model. Okay, and the curve is the lowest point, and to the left of it is the sell side of the curve. To the right of it is the buy side of the curve, and you'll be taught more specifics about that. But I'll give you a lot of hints in here and try to get your gears turning. We're going to drop down into a 8-hour chart. Just be mindful that this candle right here sets the tone for when the big move is going to come. It's going to be after this candle here. Now, when does it usually happen? It's either the very next day or the day after. So it gives you, like, worst case scenario, you're going to have to wait 2 days. But if it doesn't happen on the third day, it's not likely to happen. You're probably going to have a more prolonged consolidation before the directional bias resumes in your favor. And again, at this moment here, we're bullish. Why? Because it's part of the market maker buy model. It's going to run the original consolidation here, and then ultimately it's going to try to get up and fill this gap. Now, it doesn't have time because the contract delivery month for June, crude oil, the contracts stop trading because futures contracts have expirations. That part is part of the inherent risks of trading futures. So you have to keep a watchful eye of when your contract's going to expire, when open interest starts to diminish and build up to a larger degree in the next month out. In this case, it would be July contract for crude oil. And again, the symbol for that month is N, whereas June is M. All right, so let's drop into an 8-hour chart. All right, so here is the crude oil 8-hour chart. And you can see that area here where it was creating that small little compression candle. That move that took place after that, if you look to the left, okay, look over here, all of this cut right through all those candles, and you see this area right in here. We're going to find on a 4-hour chart, we'll drop down in again, but right in here and right in here, there's an area where there is a bullish candle. Okay, in other words, there's an up close candle. So this is the curve. So everything to the left of this is all sell side. So if the algorithm is offering sell side here on the right of the curve, every time it comes back to these areas over here, it's going to act like an order block. It's going to pick up more orders and allow the market to expand up to clear the original consolidation. That is not Wyckoff. Okay, that's not Wyckoff. So anyone that's ever studied Wyckoff will right away quickly see that that is absolutely not taught in Wyckoff. There's no discussion of how it matches exactly over here to here. That's not in there. It's not support and resistance. It's not supply and demand. It's none of those things. All right, so now that we have that, I want to drop down into the 4-hour chart, and you'll see right away what I'm referring to. All right, so sell side of the curve here. Up close candles, up close candles, up close candle. There's an up close candle here. And what you're looking for in all of this is you want to see where the market moved quickly away, where it moved quickly away from the up close candles. And I'll annotate that now. All right, so you can see the sell side of the curve projected through from the left side to the right side of the curve. Bam, it hits it there. Optimal trade entry there. And then we go into that small little compression candle on the daily chart. and then we drop down into the main threshold of this up close candle, trades to it here, and that is on the 13th, and then we start to move into the 14th, and then we have the expansion move up. All of that lends well to what side of the marketplace you're looking for. You're anticipating a large move because of the compression candle on the daily chart. It's part of a market maker buy model. You know you're looking for the original consolidation, the buy side liquidity resting there, and in that gap that's referred to with these two blue lines. That's a big, huge daily cap, and it's going to likely draw price up there. Again, the fact that we expired on the June contract doesn't negate or remove the bias that lends that this is likely where the market's going to reach for, but the very near term here, and you can see that the June contract does in fact at least do that here and here. So that's the bias there. And let's go into the chart here. You can see how the market drops down in, creates the optimal trade entry, and then all the things that lent well with the description on the daily and 8-hour and 4-hour chart, you can see actually delivers beautifully here. This is just one entry on a day trade, but utilizing it with short-term trading and or swing trading, you can see how that day could have facilitated your entry, not just for the everyday bread and butter setup, which is fine, but it allows you also to participate in a more sustained price move, as you can see there. So that's how you work out the short-term trading and day trading. We use that model, and when you become a charter member, you'll actually see me referred to in the models and in the trading plans, where if you want to use the intraday, very short-term time frames for scalping to minimize the risk and put yourself in trades that would pay out a lot larger R multiple, then this is what it is here. And you get a lot of folks that say, oh, I'm a 20 pip guy. I'm a 20 pip guy because I can do a lot with 20 pips. I can create a lot of velocity with the equity because I can turn it over a lot. Whereas someone that trades in here, and the risk associated with something like that, is very, very small compared to the multiple that pays out to the gap. So in this case here, if you were trading here in May, you could have elected to use the June contract initially to get in the trade, and then when it creates an opportunity to retrace, you can actually roll over, close the trade on the nearby contract, which is the June here at that time, and then buy the July contract. Okay, so that way it gives you a little bit more holding time before it would expire. Now I'll give you an example of what that looks like here. So here's the 15th, and I'm going to change the symbol to July crude, and we'll watch it from the 14th. So here's the July contract of crude oil. So you can see the much more lengthier rally it took place in crude oil. Took us up into 38s, 39s, ultimately hit the 40s, and that's the closure on that gap on the daily chart. So again, all of these ideas fit together to give you a longer term price action model that would deliver not just day trades, not scalps. I get a lot of flack from students that are really not acclimated to using these intraday charts. They're just completely opposed to doing it. And I understand, but you still have to submit to learning how to do this with them, because it will give you exactly what you're looking for. You want to be able to swing trade, you want to be able to short-term trade or position trade, and that's fine, that's great if it matches your personality. But if it doesn't match your personality, then short-term trading is going to be an easy fix for you. Even if you're going to be a long-term swing trader or a position trader, using the scalping ideas, you can go in with very, very small short-term risk, much more reduced than what I show in the models. Like I said, there's parts of the trading plans and the price action models where I insert the ideas like I'm showing you here, where on the 14th of May, in here you're getting a buy signal that's very nice, that allows you to run above the original consolidation and up into that daily. And I'll let you see the daily chart here. Here's the gap, and here we traded up into the gap. Okay, so while it may not be a market that you're willing to trade or interested in trading, all the things that you're learning in the core content are applicable here. So I just wanted to make a better case of just fleshing out not just a simple intraday scout with the crude oil market, but also get in sync with what we were already talking about anyway, which was that gap and how it would likely trade up into that. And it still looks like it might want to come up in here and trade a little bit more. So I'll just throw this in here for no extra charge. So here's July likelihood of an upside objective. If we don't get that, then it's the next month delivery. Okay, we're looking for a complete closure of this gap. And if it wants to run back up to the bearish order block, that'd be something else. So there you go, no extra charge for that one. Let's go into our example number 7. All right, so here is our example number 7. This is a British pound sell for May 15th, 2020. And you can see right in here the price action. Now, before I add any of the annotations, I want you to look at what you're seeing here and try to think about how the market moves in these market maker buy and sell models, because you don't hear me talk a lot about it in the reviews and all that, because it's really part of your unique personal study. You're supposed to be looking for this yourself. So have that in mind. I'm giving you a little bit of a nudge here to think about it, but we can see the consolidation in here. We leave the consolidation, we come back up, rebalance, break down multiple times in here. They're accumulating inside of this small little range here, this little trading range. Every time it breaks down, it rebalances, comes back to the bearish order block. It breaks down, rebalances, comes back to the bearish order block, and then breaks hard, consolidation, breaks down, and we have a smart money reversal. And we'll talk about that when we get into the next example, how they dovetail together. But let's add the annotations here. You can see the original consolidation. Okay, and the idea is you could have said this low and all the way up to this high. That could have been your version of the consolidation. To me, I just like to use where the market creates the high and breaks down and consolidates. There would be nothing wrong if you used it over here or even over here. Okay, it's all part of the experience factor, and you'll get better at it too. Sometimes when I'm looking at the charts, and listen closely, folks, sometimes when I'm looking at the charts, I'll have in my own personal journal an area that I'm classifying as a smart money consolidation or original consolidation. Then it breaks down towards the discounted rate I'm looking for it to trade to, which builds a market maker buy model. So in other words, we're consolidating, creating shorts. The market breaks down and then creates a smart money reversal here, which we'll look at again when we get into the next example. But in here, you can see the fair value gap here in the form of a SIBI, sell side imbalance, buy side inefficiency. We trade up into that here. And then we break down, small little tiny little gap in here. Go back and rewind the video before I added the annotations, and you'll see that small little fair value gap. Extend that through. Again, this is the reason why we are not supply and demand. We are not teaching that stuff here. This gap in here, when it created the gap here, it was a BISI, buy side imbalance, sell side inefficiency. It comes down and gives it what? Closure. But is it done? No, we extend any gap in time because it fits the narrative. This becomes what? This is a area. Look at the bodies of the candle. Again, not the wicks. You have to endure this. That's the pain. That's the risk involved. But the bodies of the candles, look what's going on. It goes right back up again, bodies of the candles, and distribution. Okay, so we have optimal trade entry here. We have optimal trade entry here. But more specifically, you don't even need the fib. As I mentioned in the YouTube series, and as I say all the time here, you don't see me doing a lot of fib work because the fib is just a little crutch. Okay, it's like a training wheel to help you see something that you'll grow out of. You don't need a Fibonacci. Okay, you don't need it. But when you have these levels in here for institutional order flow, as I teach it in the core content, it sets the stage for the distribution and ultimately down into an area where we would look for profit taking and potentially looking for evidence for smart money reversal, because this is a higher time frame discount array. And I'll let you look at the charts and see what that is. But everything in here is all part of a market maker buy model, and this would be the curve. Okay, so we'll add that way it'll be in the chart when we start talking about example number 8. So that's the lowest of the low right there. All right, so there's the details and what we would be looking for and how it works for us in the sense that it's breaking down, moving lower. So now we're going to go into example number 8, which is the buy signal that occurred on May 18th for the same pair cable. All right, so here's the 18th, and here's the optimal trade entry that occurred on that New York setup. And here is the mentorship level perspective. Over here to the left of the curve, remember, this is our consolidation. It breaks down, returns back to the consolidation, distribution, and a big drop down in here. So this up close candle is what I'm looking at and highlighting and extending to the left of the curve to the right side of the curve and keep extending it out there, okay? Inside of these up close candles to the left of the curve, extended it over into the right hand side, is where all of your buys are going to occur. It's just that simple because everything is algorithmic. Everything that creates a sell over here will create a buy over here. It's perfectly lined up like that. Your optimal trade entry occurs in here. You have a fair value gap here in the form of a BISI, buy side imbalance, sell side inefficiency. Let me take that off so you can see it. See? Trade down into it there. Then we expand up. Institutional order flow entry drill. Boom, hits it, rallies away. What's it reaching for? Well, look at this area of distribution. So ahead of this drop, anyone that was short, where's their logical stop loss? Right here. So what's going to be resting above that? Buy side liquidity. And it's also basically the bottom end of the original consolidation. So between this low and this high, in that area, there's going to be layered buy side liquidity. In other words, buy stops protecting anyone short. That is where you sell to willing buyers at a higher price. Because over here, you would be buying because now you're part of the market maker buy model. Buying here, objective is the first target right above here. And if you put a line on that, right there, you can see from here, we rally pretty aggressively until we get above that. We retrace again into a fair value gap again, and then explosion to the upside again, reaching for the liquidity resting above here inside the consolidation. Okay, so it runs that. But is it ran pretty convincingly? No, it's shallow. So it's retracing, gathering more steam to do what? Likely continue. Remember what I just showed you with crude oil. This area here is a swing trade idea that gets you above the original consolidation up here. So let's add our level to here. So that's where the next draw on liquidity is going to be. But thinking about entering here and holding the whole time. Bam. See that? So your entry on the New York setup here, low to high, retracement, fair value gap, rallies, consolidates, pops through, clears the liquidity above the original consolidation of the market maker buy model. And I'll scrunch this up so you can see a little bit more. And there's the market maker buy model. And then everything that matches on the left side with the right side for accumulation. Same way over here. Every up close candle in here, or consecutive up close candles, take that, extend that in time for homework, you'll see that that's where you're getting the buys over here. And everything matches up. There's nothing random, folks. So hopefully you found this insightful. I will talk to you tomorrow with examples number 9, 10, and 11. Wish good luck and good trading.